Welcome to The Explainer. Today, we're digging into a really weird situation with a company called Rezolve AI, based on some analysis from the creative investor. It's a classic case of a company that's absolutely crushing it, growing like crazy, but its stock price seems to be stuck in the mud. So let's get into it and figure out why. I mean, this is a paradox that so many investors run into, right? You find a company, it seems to be firing on all cylinders, the business is booming, and yet when you look at the stock chart, it's a completely different and, let's be honest, a really frustrating story. How does that even happen? And the situation at Rezolve AI is the perfect example of this. Our source describes it as a true love-hate relationship for investors. They absolutely love the business and what it's doing, but they are just getting totally burned by the stock's performance. Things really came to a head with this post on X from the CEO, Dan Wagner. He laid out all the reasons the company was doing great and basically told investors to just relax. But the source we're looking at called this gaslighting. Basically dismissing the very real concerns of shareholders about a problem that, from their perspective, management was actually creating.
And here it is, the whole conflict laid out side by side. On one hand, the business is executing just brilliantly. I mean, we're talking about 10x revenue growth, a ton of cash on hand. But on the other hand, the stock is a total laggard, and that's what's creating all this frustration.
So this is the million-dollar question, isn't it? If the company is doing everything right on the business side of things, what is this invisible anchor that's just weighing the stock price down? Well, our source points to one single primary culprit, and it's a concept that every single investor really needs to get their head around: shareholder dilution. It's described as pretty much the only thing driving the stock down. So what is dilution? I love this pizza analogy because it just makes it so clear. Imagine the company is a pizza. When it issues new shares to raise money, the pizza itself doesn't get any bigger, they just cut it into more and more slices. So even if the whole pizza is worth more, your slice is now smaller and it's worth less. And for Rezolve, we are not talking about a small issue here. Management has the green light to sell another 137.5 million shares. So to stick with our analogy, that is a massive number of new slices they can add to the pizza at any time. And that creates this constant downward pressure on the stock price.
And this table, wow, it just shows you the problem perfectly. Take a look at this. The company's valuation literally doubles. It goes from $1.5 billion to $3 billion. That is an incredible accomplishment. But because the number of shares out there also doubles, the share price goes absolutely nowhere. Your investment is totally flat, even while the company is killing it. Okay, so if you know the company is in what our source calls a hyper-dilutive phase, what do? How do you even play this? Well, the strategy that's proposed is kind of like a game of whack-a-mole.
The strategy, according to the source, is actually pretty simple. When the stock gets pushed down, let's say under $250 a share, the theory is that management is less likely to sell more shares and dilute everyone. That's your signal to maybe buy. But when the price pops up, say above $350, that's when the risk comes back, because it's a much better price for the company to raise cash. And that's your signal to be cautious. And this whole thing really comes down to a classic piece of investment wisdom our source brings up. You make money when you buy a stock, not when you sell it. In a tricky situation like this, it's all about hitting that mole at just the right low price. That's where the real profit is made. So what does this all mean for your expectations? Well, it means you've got to adjust your timeline. The source suggests that because this dilution is an ongoing thing, an investment that might have looked like a 1 or 2 year play now really needs to be seen as a 3 to 5 year hold as you wait for this whole phase to be over. But a company doesn't exist in a vacuum, right? Its internal story is only half the picture. Our source also points to the wider market and suggests there might be a storm brewing that could actually play right into this strategy.
Yeah, the source points to a whole swirl of things out there that could bring some serious volatility. We're talking about everything from Supreme Court rulings to the Fed to big tech earnings, even a snap election in Japan and the threat of a government shutdown here. It's a long list of potential disruptors that have absolutely nothing to do with Rezolve itself.
Now, here's the wild part, the totally counterintuitive piece of this whole strategy. A big market downturn, which would be painful for most of your portfolio, could be the very thing that pushes a stock like Rezolve down into that perfect buy zone. This external chaos could actually create an amazing opportunity for investors who have cash ready to go. All right, let's pull all these threads together. After digging into the company, the stock, and the market, what's the real takeaway here for any investor? It really boils down to this 3-step framework. First, you have to separate the company from the stock. A fantastic business isn't always a great investment, at least not right away. Second, you've got to dig in and analyze those internal pressures, like dilution, that might be holding the stock price down. And third, you need to be ready to use that big picture external market chaos to your advantage.
And that leaves us with this one last thing to chew on. When you're faced with a situation like this one and you're told you need to wait 3, 4, maybe 5 years for a payoff, are you using a patient long-term strategy, or are you just hoping that things will eventually work out? That's something every investor has to decide for themselves.